ASI had a tougher row to hoe during the Great Recession. That was caused by the financial crisis from like 2008 to 2010. The collapse of the residential real estate market. And in particular, the effects of that Great Recession and financial crisis were strongest in 4 states, and we sort of jokingly call them the sand states: Nevada, Arizona, Florida, and California. Those were the 4 most impacted states during the Great Recession. And since credit unions make quite a few mortgage loans, credit unions were quite exposed to the 50 to 60% declines in real estate values and the quadrupling and more of foreclosure rates as a result of that. ASI was, relatively speaking, more exposed to those sand states than NCUA was. About 45% of the insured shares of ASI credit unions were in 2 of those 4 states, in California and Nevada. Only about 23% of NCUA's insured shares were in all 4 of those states. They helped out, they closed down some credit unions, they nursed some other credit unions through to health again. So, there are a few credit unions now that probably look like they should have been shut down, but they weren't, because ASI made the judgment that no, this is a temporary external problem, we can fix this, and they did. Those are strong, healthy, viable credit unions today. So for me, sort of the proof of the pudding is the fact that ASI was able, with its really high exposure to 2 of those 4 states, was still able to come through the Great Recession. It stayed well capitalized throughout. It's very well capitalized now. It's in good shape. So I think ASI has proved itself in a very difficult time as being able to handle these sorts of problems.